Mortgage loan rates are set by the bond market, buying and selling of bonds, and not the Fed funds rate. So let's talk about the difference. What is the Fed funds rate? That is the interest rate that banks charge each other, usually for overnight lending. The Federal Reserve System, or the Fed as we call it, doesn't directly set mortgage rates or credit card rates, but it does control the base rate, and that influences pretty much everything else. Why do banks borrow from each other? Well, they're required to keep a certain amount of cash on hand. And at the end of the day, one bank may have too little cash, another may have extra cash. And so they lend to each other overnight using the Fed funds rate. Think of it this way: the Fed sets the temperature of the economy, the banks adjust everything else based on temperature. When the Fed raises this rate, borrowing gets more expensive, spending slows down, and inflation cools. When the Fed lowers it, borrowing gets cheaper, spending increases, and economic activity speeds up. The U.S. prime rate is the interest rate that banks give to their most credit-worthy customers, like big companies and top-tier borrowers. Consumers rarely get prime itself, but many loans are based on it. So examples might be a credit card, so it's prime plus whatever, HELOCs, prime plus the margin, and some adjustable loans. So you can look at it this way: the Fed funds rate plus about 3% is the prime rate. So when the Fed moves rates, prime usually changes almost immediately. The Fed funds rate might be 2.5%, and then the prime rate is 5.5%, or the Fed funds rate is 5.5%, then the prime rate would be 8.5%. Make sense? Now, why does this matter to everyday people? Well, it matters because of credit card rates, home equity lines of credit, and home equity loans, car loans, savings account yields, and short-term borrowing costs. But an important mortgage note: the Fed does not directly set mortgage rates. Mortgage rates follow the bond markets, inflation expectations, and mortgage-backed securities, which is why mortgage rates sometimes fall even when the Fed isn't cutting. The bottom line: the Fed funds rate is what banks charge each other, and the prime rate is what the banks charge their best customers, and many consumer loans are built off of prime. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.